Hi everyone, my name is Rusmin and I'm the co-founder of The Fifth Person. In this video, I'm going to explain to you which of the following stocks you should actually invest your money in if you're trying to grow your wealth in the stock market. And let's go through the characteristics of growth stock. Okay, so if you look at most growth stocks that are listed in the market today, most of them typically have a growth rate of between at least 10%. Okay, so because they are still growing, okay, and they may able to grow at a higher pace, and sometimes could be as high as 50%. Okay, so that can be quite scary. But with the internet, okay, this actually allow a lot of companies to grow at an even faster pace than the economy. And typically, most growth stocks, they don't really pay a lot of dividends because they are reinvesting those earnings that they have earned back into the business, either to expand into new facilities or go into different markets. Okay, so those money will be reinvested for a lot of smaller companies. Okay, and for most of them, of course, the dividends are generally no dividends. Okay, they may pay zero dividend, but there are companies that are growing very fast. At the same time, they may pay a little bit of dividends. Okay, so I would say that the dividend will be very, very low. And this is what we call it as a payout ratio, and the payout ratio typically within less than 50%. Okay, and of course, next, those companies that are usually at the growing stage tends to be in the smaller market cap. Market cap basically the value of the company, and typically they are small, all right, to mid cap. Okay, so depending on which market we are in, if you are talking about US market, small cap typically referring to those companies that is valued at less than 3 billion. Okay, so if you're talking to Asia, most companies, those that are actually in the growing stage, are typically valued at less than $1 billion US dollars. And if you are looking for mid cap, typically in the US, you're talking about 3 billion to about 10 billion, whereas for Asia, I would say mid cap is typically between 1 billion to about less than 5 billion. Okay, so an expected return if you were to invest your money into growth stock, and your return typically you want to have at least 2 times of return in 5 years. Okay, so this is generally the time frame. And of course, there are companies that are growing at a faster stage. They may deliver 2 times, 3 times, or even 5 times within 5 years. Okay, so this is the expected return. Okay, so growth companies, of course, in terms of volatility, tends to be on the higher side, mid to high. And this company generally, as they grow, they do not really have a established system, so they need to actually establish them at the very start stage. And when they do, sometimes they may fail. Okay, so there are a lot of risks involved in a lot of young growing companies. They need to recruit talents, they need to execute their strategies, so a lot of unknowns. So growth stocks generally are more volatile as compared to the income stock. Okay, but in terms of income stock, if you look at their growth percentage, because they have more or less matured, their growth rate tends to be together alongside with the economy. Because if the economy in the country is actually growing at 3%, usually their growth rate will be about 3%, 4%, 5%. Okay, slightly better, or usually most of the time is equivalent to the economic growth rate. Okay, so I'll put as 1% to not more than 10%. Okay, so this is the typical growth rate for a lot of income stock, because they are a lot more established. They have a lot of product and services are being used by a lot of their customers, and they have actually stabilized, and they tends to pay out a lot of dividend because they no longer reinvest those earnings. So what they do with the money is that they pay back to you as investors. Okay, so their payout ratios tend to be, I would say, mid to high, and typically above 50% to not more than 100%. Okay, so, and if you look at the market cap for income stocks, typically you're looking at mid to large cap. Okay, so these are what we call as blue chips. Okay, so sometimes we call them as blue chip company because they are very, very stable and they pay very good dividends. Okay, typically for returns, if you're looking to invest into income stock, the return, I would say, generally between 5%, okay, to maybe 10%. Okay, so and in terms of volatility for income stock, I would generally say classify them as low to mid. Okay, so now the question is, how should you invest your money in this growth stocks or income stock? Okay, Okay, there are three main categories or three main factors that you need to consider before you make your decision on whether you should invest into income stock or growth stock. Okay, so the first one will be risk. Okay, so this is really depend on your own risk appetite. How much risk are you able to stomach? And in terms of the volatility, so like growth companies, the volatility tends to be higher. For income stock, the volatility tends to be much lower. So if you are someone, if you realize that you cannot sleep well at night because when you invest in certain stocks, okay, and the stock come with high volatility, then you may want to shift your focus into focusing on income stocks. Okay, and also next of course will be your return, and what is your expected return. If you want to have high return, let's say 15%, 20%, of course you can only look at growth companies. Okay, and of course the other one will be the capital. Okay, so depend on how much initial capital that you begin with. If your capital is really very small, you may want to focus more on growth stock. Okay, and at the same time, usually you have little capital, you tend to be much younger. Okay, so let me probably draw the line for you. Okay, so let's say if you're in a somewhere young age, okay, and also somewhere if you are old. Okay, when I say young, if you're early 20s, if you're old, probably like 50s, 60s. Okay, so that will give you some rough guide. Okay, so as a young people, generally your risk appetites tend to be higher, and if you're old, you tend to have a lot of capital. Okay, so you want to preserve those capital. You do not want to risk it, because once you lose the money, you do not have the earning power back when you were in the old days where you can still make a lot of money. Okay, so young people generally tend to have lesser capital because after you study finish, you graduate from the school, you need to find a job, and this is where you start to build your first initial capital. Okay, so your capital tend to be much lower, but of course, as a young people, young investors, your timelines tend to be longer. You have a lot time more, and you can actually afford to take on more risk and actually generate more return. Okay, so if you are old, of course your return, you need to reduce your expectation because you can no longer take more risk. Okay, so depending on where you are, you can actually structure according to your own needs. Okay, so what I want to highlight next, of course, is that you don't really have to focus on your whole portfolio just purely on growth, or another portfolio focus mainly on just the income. Okay, you don't have to be on the extreme one end. Okay, so let me share with you this rule of 100, which I find it quite useful. Okay, so what this rule of 100 basically saying is that you just take 100 minus off your age, and that will be your percentage of the allocation in the portfolio that can actually afford to take risk. Okay, so let me share with you example. Let's say if it's your age is around 30s, okay, and basically you may want to set aside 70%, 100 minus 30, you get 70% of your portfolio in growth stock. Okay, because you're a lot younger, your capitals are a lot smaller, you can actually invest in those companies that are growing at a much faster rate, a double digit. And of course, income, you may actually set it as 30%. Okay, if you are someone in your 50s, then maybe you can actually do a 50-50 split between income and growth. Okay, so like I said, you don't really have to be fully 100% in growth or 100% in income. Okay, but of course, this is just as a rule of thumb, and everyone's risk appetite may be different. I have speak to some investors who are in their 30s. They say they don't like to take on risk. They don't like to see the share prices in their portfolio fluctuates up and down 5%, 10% in the day. Okay, so of course they actually structured the other way around. Instead of growth 70%, they actually structure income 70%. Okay, so at the end of the day, how you're going to structure your portfolio, it will really depend on the risk appetite. Okay, so I hope you learned a lot from this video, and if you enjoy and if you think that this video may be beneficial for your friends, please feel free to share it with him or her. Okay, so if you want more investment analysis or insight, please go to fifthpersons.com. Once again, this is Rusmin, and I'm the co-founder of the Fifth Person, and I will talk to you soon.